My name is Rob McGaffin, and with a range of stakeholders and other parties involved, as a part of a co-founder of the housing finance course for Sub-Saharan Africa, which we kicked off in 2012 with the assistance of the International Housing Finance course, which was run by Dr. Marja Hoek-Smit, and with the Center for Affordable Housing Finance, and then later on the African Union for Housing Finance. The course is particularly housed within the Urban Real Estate Research Unit at UCT, which is headed up by Francois Viruly, and who Francois is also then the director of the course itself. We will give you some more information about the course, but it kicks off in the first week of October, and registration is still open, which we will speak to a bit later on. Folks, the way this afternoon is going to work is Marja Hoek-Smit is going to give us a presentation that looks at the relationship, or I should say, looks at the role of government and housing finance, but probably more importantly, is that's the relationship between housing markets and housing finance markets. And should hopefully give a good teaser of some of the areas that we will address and look at in a lot more detail in the upcoming course. After the presentation, myself, Francois, Casey, etc., will kick off with the first round of questions with respect to the presentation. And then we'll open it up to the floor for general questions and discussion. The intention is to keep this session to about an hour, maybe fractionally over a little bit, but we obviously want to respect everybody's time. And so from my side, I would just like to thank you all for participating. A specific and special thanks to Marja Hoek-Smit for joining us and for actually giving the presentation. Marja and I co-run the course, and one of the huge upsides or benefits of partaking in the course is you get access to what I would argue is the leading housing and housing finance person in the world for over a 2-week period. So I'm really grateful for Marja for taking the time this afternoon. And then a big thanks to the Center for Affordable Housing Finance and the African Union for housing finance, in particular, Tandiwe, for actually doing a lot of the hard yards behind the scene to kick it off. Without any further delay, I'd just like to introduce, for those of you who do not know Marja Hoek-Smit, she is the retired adjunct professor at the Wharton Real Estate Center, and has been involved with Wharton for a number of years, and included running the International Housing Finance course, I think, Marja, for over 30 years, if I'm not mistaken.
37 years.
37. I always get it wrong. It always amazes me that, etc. So thank you. So folks, I'm going to then hand over to Marja, who will take us through the presentation, and then we will pick up the questions afterwards. If in the interim you don't want to hold your question to the end, please just put it into the chat room, and we'll see whether we can answer it during the presentation, but otherwise we'll hold over those questions to after the presentation. Marja, thank you very much, and handing over to you.
Yeah. Thanks, Rob, for the introduction. And hello, everyone who is participating in this session. This session is, of course, a teaser. It is really a teaser. It is a teaser for the 2-week housing finance program that Cape Town University is running now for several years. So don't expect to get all the answers. You may end up with more questions in the end, but that is why we have a 2-week course to provide you with more answers than I can give in this hour. What I want to do is, Rob already mentioned why we started the housing finance course. He briefly mentioned that for Sub-Saharan Africa. We had this course at the Wharton School as a global course for emerging markets. But in Sub-Saharan Africa, the housing problems are of a specific nature. So we thought that it would be much better to develop a course that specifically targets the problems in the housing finance sector in sub-Saharan African countries. And sub-Saharan Africa was different in many ways. First of all, the scale of the urban housing problems is much larger than anywhere else in the world. And the housing finance sector, both for developer finance as well as for housing finance, is very stressed, very small, and it's very difficult for developers to get finance for their projects, as well as for end users who want to acquire housing. So the stress on the housing sector is larger, much larger in sub-Saharan Africa than in any continent in the world. And that is why we started this course, particularly focused on the problem for sub-Saharan Africa. And the focus of the course is very much what the private sector and the non-profit sector can do by way of innovations that can lead to an expansion of housing markets and housing finance markets, and what the role, the very critical role is of government policies in this space. If the government doesn't do whatever they have to do by way of regulation, taxation, subsidies to open up the housing market and the housing finance market, it is very difficult for the private players to actually expand. So we focus on these two sets of players, the government and the private and NGO sector. And then we give many relevant examples during the course of countries that have gone through this opening up and expansion of their housing market. And we give many case studies. That is how we have structured, and that is the course for Sub-Saharan Africa and the motivation behind it. What I do for this teaser workshop, it's always difficult to know what to emphasize during this short 1 hour workshop. But I should be at fault if I didn't begin to address very quickly the current macroeconomic challenges that are particularly detrimental for the housing finance system. So I will briefly talk about the macroeconomic conditions as we have them at the moment, and then not start right away jumping into housing finance. But first things first, I say here, first we must understand the housing market. We must understand the fundamentals of the demand side of the market and the supply side of the market. So I do that, and I focus particularly on the critical role, again, of government, the ministries of housing, other parts of the government, like the Ministry of Finance and so on. So we first focus on housing markets. And once we have an overview of how housing markets work, we then go to the critical role of housing finance, both on the demand side to make it possible for consumers, for you and I, to get into the market and buy housing with finance, and on the supply side, if developers do not get housing finance for their project development, we are not going anywhere, basically. So we then talk about the critical role and details of the housing finance system, and we end with the priorities for housing finance policies to expand access to housing finance. And of course, this is all a teaser. So I mentioned the major priorities, but the detailing of all these different tools and the analysis of the different systems, that has to wait until we have the course in the beginning of October. So I hope this whets your appetite this course so that you, after this hour is over, all will begin to click on registration and come into the housing finance course, where we do all of this, but in a much greater detail. So let me then do the first part first. The current macroeconomic challenges that impact the housing and the housing finance sector in Sub-Saharan Africa, but not only in Sub-Saharan Africa. It's a problem in the US, it's a problem in Europe and Asia and Latin America. What is going on? We have multiple crises, particularly in emerging markets. An enormous strain on the finances because of the COVID situation that decreased economic growth enormously in most countries. It also increased debt levels in most countries very much. And all of that, the coronavirus depression was followed by soaring global inflation. And that had to do with the supply chain issues caused by COVID, but also with the war that is now going on in Ukraine and all the shortages in particularly the food supply and the energy supply. So we see then a tightening of monetary policy in advanced economies, and what is most important, tightening of monetary policy in the United States. And that's very important for the effects it has on emerging markets. So what is happening is then we have deceleration of economic growth in many emerging markets, and I will show you the figures in a minute. We see shifts from investors away from emerging markets because now the interest rates in advanced economies, including in the United States, are much higher. We have much higher interest rates. So investors are now moving their money out of emerging markets and into the United States particularly. So these trends are very impactful on what emerging markets can do by way of housing finance and whether they have the fiscal space to support the development of the housing markets. So let us quickly look at the numbers. Here we see for Sub-Saharan Africa, the real GDP growth, a big dip as a consequence of COVID. We came out nicely, emerging markets recovered very well, and now we have this second wave of problems with inflation and so on. And now we see another dip in GDP growth. Here I show that the IMF is continuously revising GDP growth figures downwards for all countries, but mostly for Sub-Saharan Africa. So even the projections for 2023 are not looking very good. So that is the GDP part. The other part is that Sub-Saharan Africa has increased their public debt. You can see that between 2010 and 2020, the public debt in Africa as a percentage of GDP has increased enormously, and particularly domestic debt. So the sovereign debt issued by the countries themselves. Who is holding that sovereign debt? And that is where we have to pay attention. Most of a large part of sovereign debt is held by the banking sector. And because of all these macroeconomic pressures, the countries in Sub-Saharan Africa have to increase the price of that debt. So it's actually good business for the banking sector to buy sovereign debt It's risk-free, and they have now 20% or more, and much more in some countries, of all of their assets in sovereign debt of the countries. Why do I mention that? When banks see it is advantageous for them to hold risk-free money at a good rate that they can access from through government paper, they do not use their funds to make loans, which is really what they should do with their money. So this is a bit of a problematic picture that is developing in a negative way in emerging markets. Also, the high debt exposure of the countries limit the fiscal space that the Ministry of Finance has to provide for social projects, for health, education, and housing. So that increased public debt in times of stress, like at the moment, when that debt is getting more and more expensive, is a hindrance for the housing sector. Here is the picture that we now have on inflation. And as I said, the IMF is changing these figures every few months. These are the latest predictions. They say Sub-Saharan Africa's inflation is roughly at the moment 12%, and projected only to decline to close to 10% in 2023. That means that inflation is with us for a while. It is not going to dissipate immediately. You know, it is a problem, particularly because of the depreciation of the domestic currencies against the US dollar. And that, of course, has consequences for how expensive your imports are. Housing, fortunately, does not have to have a large component of imported material. In fact, it does, but it shouldn't. But we come to talk about that in a minute. All right, inflation in food prices has hit Sub-Saharan Africa the most. You can see that in this graph. Sub-Saharan Africa's food prices food expenditures are the largest part of the consumer price index, much larger as a proportion than in comparison to other countries. And it is particularly the food prices that drive this inflationary trend. That means that if households have to spend much more on food than they did in the past as a percentage of their overall budget, there is less left over to pay for housing. And people may want to postpone investing in their housing because they're so stressed because of food prices, particularly if the increase in incomes do not go hand in glove with inflation. And there is, in the end, incomes always adjust to inflation, but in the interim period, there is a big gap in most countries. So this is a particularly difficult time for the housing sector because of all these macroeconomic trends. As I already mentioned before, the US dollar has strengthened enormously, and you can see that in this graph. It makes imports more expensive, particularly, and the repayment of the debt is much more expensive when the dollar is stronger relative to the local currencies. So all these trends together have a major impact on what we can expect to do for the housing sector. So that volatility in the macroeconomy, I say here, makes very poor bedfellows with housing. Because if there is one thing that we need for the housing sector to flourish, is a stable macroeconomy that can support the lending for housing. And lending for housing is long-term. And if we do not know as a banker what inflation and therefore interest rates are going to be, it's very difficult to commit to long-term lending. So we have major impacts on the lending side. But first of all, let me start with the effects on house prices. In advanced economies where we have a major dependence on the mortgage sector for housing development, we see house prices decrease when we have higher interest rates. That is not yet kicking in many advanced economies, although Europe is showing signs that is beginning to happen. In emerging markets with very small mortgage sectors, that effect is not noticeable. The effect that is noticeable is that we see price increases because building materials, higher interest rates, all make housing more unaffordable, more expensive. And affordability is therefore an issue right at this moment in most emerging markets, and particularly Sub-Saharan Africa. Of course, on the finance side, we see an enormous effect. It reduces, if we have higher interest rates, and the interest rates are volatile because of inflation, we see a reduced demand for loans because people simply can't afford loans. It is that simple. It impacts also the supply of loans, as I mentioned. Bankers will stop making long-term loans because they can't foresee what the interest rates are going to be. Certainly, if the expectation is that they make loans at a fixed rate for a long time, that is very difficult for lenders to do in times of inflation. Banks see that the sovereign bonds, as I mentioned earlier, give a very high return and are risk-free. So why making loans with great risk attached if you can invest in sovereign bonds? So that is another issue, and we have, of course, the danger, therefore, of stagnation in the housing sector. And precisely at the point that we need to stimulate GDP, we need to stimulate economic growth. And right now, that is made more difficult because of this additional inflationary pressure. And then the fiscal space I already mentioned, the Ministry of Finance has to spend more of the budget that they have available for debt servicing, and less is left over to support the supply of housing, amongst many other demands on the budget. So that sounds very difficult. At the same time, what I want to emphasize and come back to several times in this short lecture, housing, the housing sector offers enormous opportunities for economic growth. And particularly in the time of downturn, economic downturn, we have to look at sectors that very quickly can begin to generate economic growth. Because the best way to reach sustainable debt levels and restore the fiscal balance in an economy is through economic growth. And housing, most people do not understand this, and it's very important. The housing sector is a very large part of the economy, larger than manufacturing, larger than many other sectors that intuitively we think are the biggest part of the economy. Housing has contributes 16 to 20% in emerging markets of GDP of the country, both through the consumption of housing. Housing generates income streams through rents and imputed rents for owners. Owners should pay rent, the rent equivalent, we call it, for owners. That is the consumption part. That's very high. And then the investment part, new construction, home improvement. Then we look at the figures for the United States. I give them because they are the most detailed, but we now also have fairly good figures for emerging markets, but not in the same level of precision. In the United States, you see here the contribution of the housing sector to the GDP of the country is 19%. And that comes from 11% on housing services, the rents paid, the rents that owners should pay, the household operation, utilities and everything. And then through the investment in housing, in structures and so on. So the total contribution, the component of GDP that the housing sector contributes is close to 20%. And that is certainly the case in emerging markets where the housing sector is growing. So the housing sector can therefore fairly quickly, stimulate economic growth. And that's very important that we realize that. So it can, in that process, generate employment, which is absolutely critical, particularly since the housing sector can take unskilled labor in great quantities. It can improve investment in housing, urban productivity, and particularly important for environmental sustainability. If we invest in housing with the proper services, we do not need so many informal areas that really have a negative impact on the environment, becoming more and more important. We can improve household productivity. Better house workers have a higher productivity. We have many studies to show that. And of course, housing has an enormous impact on the social health, community health, educational outcomes of children, and so on. So the housing sector can stimulate the economy. Apart from that, it has all these additional benefits that I list here. So the housing sector, therefore, we have to take very seriously, and I don't know how many of you here are from the government sector, but the government sector has to really focus much more attention in Sub-Saharan Africa on stimulating the housing sector for all the reasons that I mentioned. That it is difficult during these macroeconomic stress periods is a given. But I come back to that on what we can do about that in the third part of this lecture. So let's now go and look at housing markets. How can we unleash that potential of the housing sector? First, we must understand markets. Whether we are government or private sector, we have to understand the demand and the supply and the constraints in the demand and the supply in the housing market. Otherwise, we don't know what we are doing, and we cannot design the right policies. So we then look at the different government policies that can improve the output in the housing market. So let's go. Housing markets are, however, and that is why we spend time on talking about the housing markets, also in the course, they're the most complex markets that you have relative to markets for cars, for any other good. Housing markets are the most complex. Why is that? Housing is durable. So if I build a house in a certain location, that house is there for 20, 30 years. I live in a house that has been in my location for more than 100 years. So the housing stock stays. It is much larger than the new additions to the housing stock. So the housing market is mostly the housing stock that exists, and very little each year is added to that housing stock relative to what is already there. And therefore, we must, as housing policymakers or lenders, we must understand that we have to focus not just on new housing by way of investment, making loans, and so on, but also the secondary market, the housing stock that is available and that is transactioning, that is being bought and sold in the marketplace. Depreciation makes that the existing housing stock normally is cheaper than new housing. So for that reason, for the affordability component, we also have to focus not just on new housing, but on the existing stock. And what that means is that let me not go any further on that. That is the most important. The second important understanding that we have to have when we talk about housing markets is that housing is expensive relative incomes. It is the most expensive consumer good that we have. And it is the most expensive asset that most households own. Therefore needs longer-term finance to pay for. If I buy a car, it's already hard enough to find the money to pay for a car over 5 years' time, for instance. But for housing, you need longer-term loans. And you need construction finance. Developers have to have finance in advance to do construction projects. So the availability and cost of finance is a very large part of affordability of housing. If I do not have finance, my affordability for housing drops enormously. If people have to pay for housing from their salary and can only build incrementally, I cannot expand my housing stock at scale. That is all very slow and peanuts. So the housing finance is critical, therefore, because housing is so expensive relative to incomes. The national level policies by the central bank on interest rates, by the Ministry of Finance and Housing are critical to make that finance available. And without finance, I always say, we have no housing market, no efficient housing market. So the third component that we have to understand that's very important in housing market analysis is that housing is local. It is built in local communities. The value and the price of housing is very much derived from the environment in which it is situated and the level of available services that the housing has. Transport, schools, etc. And so Sorry, I had a glitch here. It is much more important in many cases, the value and the price of housing and is more determined by the location, by the available services, than the cost of construction or the quality of construction. And that's important for local governments and ministries of housing to realize that it is the services around housing that determine the value in that specific location rather than the cost of construction in many cases. They are both important, but the value is derived from the environment to a large degree. If you put my house in a different location, it can be worth much more than where it is at the moment. So that is important for the government to realize. So local standards, regulations, development permits, etc., that are all issued at the local government level are very important to stimulate the supply of housing. So that whole component is also very important. So it means that for housing markets to function well, we have to realize this local component, the standards and the permits that local governments provide, and we have to think of how to pay for it, which is mostly through the finance system, and that is much more of a national central bank, Ministry of Finance issue. So, in other words, housing markets need many actors, both at the central government level, at the private national level, as well as at the local government level, in order to work efficiently. That is why housing markets are rather complex. And we need to really do a good analysis to understand where the problems are in housing markets. So how do housing markets work? We have inputs that are required: land, finance, infrastructure, labor and materials. We have to have demand for housing. We have to have demand by rental, by homeowners, and so on, driven mostly by incomes and the size of populations. And then we have the producers that have to combine this demand for housing with the input markets of land and finance and so on. So the developers, the builders, the landlords, the homeowners who construct, they are doing the production of the housing. So there are many actors involved in the housing market. And what drives the demand, we have to first understand. Because if we don't understand the demand for housing, then the developers do not know what to build where for a specific group of the population. So we need to understand what drives the demand by housing sub-market, I call it. The housing market is not one. The housing market is made up of rental and ownership. It is made up of multifamily and single family. It is made up of housing of a variety of quality and sizes. So we have many sub-markets within the overall housing market that we need to understand. And we need to understand on the demand side what the incomes are. What is the affordability level? How many people are expected to move into a particular urban area? And do they want to be homeowners? Or are they mostly renters because they can't afford home ownership? What are the prices of different kinds of housing that people are willing to pay for? For demand is willingness to pay. What are people willing to pay for what type of housing and in what type of location. We need to understand that demand before we can begin really to develop the supply for housing. Demand and supply in different market segments drive rent levels. If I have a higher demand than my supply for housing, then my cash flow into my rent levels will go up. And if rent levels go up, that's good for investors. And we will see that we may see a higher supply coming into the market because my rent levels or prices of houses are going up in that segment. So we have to do, I will not dwell on each of them, we do that in the main course, but we need to understand the demand and how it drives the supply, and whether that demand is actually creating supply depends on many other factors, on the cost and the risks to supply housing, and on government regulations, on government subsidies. So we need to understand how all these factors drive both the demand as well as the supply for housing. And whether we actually see if my demand increases for housing, either through numbers of households that demand housing, but also because of incomes and access to finance, which all determine demand for housing, the willingness and ability to pay for housing, whether that increased demand translates into an increased supply for the type of housing that people in specific markets demand and can pay for. So to analyze that, that is the government role as well as the private sector role, because the private sector ultimately has to decide where and how to build and for whom. So they must understand that the demand is there before they begin to build. These analyses are not very simple. So I just want to emphasize that we talk more about these issues in the course, of course. So we have to start to do that by a very good diagnosis of the problems, both on the demand side and on the supply side. Why is the demand low? Or why, if there is demand, does the supply for housing not come in, which is what is the case in a lot of Sub-Saharan African urban areas. So we must understand the housing problems in each location and analyze the reasons that the market fails, that the market doesn't come in when there are so many households coming into urban areas, but the supply of housing, formal housing, is not available. And we therefore see continuous growth in informal housing. Why is that? What are the specific constraints that make that the market is failing? And then we have to really determine which problems needs action by the private sector, or which problems that we have analyzed need public sector input, and define which problems can be solved by the government through facilitating the regulations, loosening the standards, by creating institutions that can that can reform, that can come into the market to help the supply of housing. So we need to understand what we can do with the legal, the regulatory, and the institutional environment to facilitate the supply of housing before we begin to think that, well, households are too poor and we have to subsidize. That subsidy should be the last resort. Can we, as a government particularly, but also there is a role for the private sector here, easing up the legal and regulatory environment so that we can create more supply without going to subsidies. But if the demand is impossible, if it is artificially low, and it requires subsidies, then what subsidies should we provide? And we have to carefully analyze the type of subsidies that would best respond to increase the demand in each of the different submarkets. And we talked to a great deal about subsidies in the course. So, and then we have to, let me stop there, otherwise I go too far afield. So we have here a schematic example of a market analysis. I divide the market here in middle income and low income. The problems in the middle income market are very different from the constraints and the demand and supply side in the low income. And we have to analyze these different segments and pinpoint the policies that we have to develop for each, the middle income as well as the low income market. So this is just by way of scheme, and you can read that slide on your own. Once we have pinpointed the specific problems in, let's say, the middle income market or the low income market, we then have to understand how to tackle these problems. And I have made this three that comes from my colleague, former colleague. He deceased, unfortunately, Dr. Grigsby. We have identified a housing problem. We then need to understand, is it for the deprived population or the non-deprived population? And if we work only on the deprived population, should we provide housing subsidies or policies or non-housing approaches like transfers of income? If it is a housing approach that we need to improve the situation, the housing situation of the deprived people, we need to understand whether we should provide subsidies or non-subsidized approach through the private sector or otherwise. If we need subsidies, and we decide that, should we subsidize the demand side, the consumer directly, or should we provide subsidies on the supply side, the developers, or the finance component? If it is supply side, should we provide shelter subsidies or non-shelter linked subsidies, new stock or existing housing, and so on and so forth? That is the decision-making tree that we have to follow. And it is very useful to build that into the decision-making by the ministries of housing and by the ministries of finance. And they need to come together on all these different decisions that and policy choices that they have to make. So this is not so simple. If you do this right, it takes a lot of effort. Then, if you have developed the right policies, and many countries have a wonderful policy, the South African housing policy is this book. But what I am always saying, policy not implemented is not policy. So if we do not commit the resources, or if the rules are not enforced, and if behavior is not changed, we have no policy. And we should always think about that. We can create a wonderful policy, but we have to really provide the implementation tools to really implement that policy. So there are public and private roles, as I already indicated, in housing development. On the supply side, let's do that first. We have to reduce cost and risk for developers to come into the market. And the government role to reduce the cost and the risk on the supply side, very critical. The government has to provide titled land and have a very good registration system. And it should ease the rules around titling of land so that it can go much faster. We have drone technology, we have all kinds of new technologies to make that happen, and it just has to be done. Then the government has a comparative advantage in producing infrastructure, for they can be paid back or on the investment in infrastructure over a very long period of time through taxes and service charges. So the government is in a better position and should therefore provide the infrastructure. That should not be done by the private sector, because if the private sector has to provide the infrastructure, the prices of housing are going up much more, and that is detrimental for affordability. So those are very critical roles for the government. Also, the level of standards and regulations, as we already talked about at the local government level, very important that the standards are realistic, that permits are issued, that we can move that supply very quickly. The government can facilitate developer finance, for instance, by providing third-party guarantees if banks are reluctant to provide developer finance. Government can use tax incentives for developers, and that has been done in many other countries, particularly for the low-income sector. The private sector is usually much better at development of housing and property management within the confines of the regulatory environment. So the role of government on the supply side is enormous, so that the private sector can actually do what it is best doing, development of housing and the management of rental properties, for instance. When we look on the demand side, of course, incomes drive demand, but that is not anything the Ministry of Housing can do about, not even the Ministry of Finance. But what we can do on the demand side is work very hard to increase access to finance, because that expands demand enormously. And the government has a big role to play, and we look at that in the next session. Oh, I'm over time. I have to move this much faster. We expand affordable and desirable housing options. That is another public role. And we can provide subsidies as a last resort. That is the role of the government. So on the supply side, on the market development, the housing market development, the government has a big role to play. Now we look at the role of housing finance, and we will go pretty fast because I already have talked about housing finance quite a lot. On the demand side, housing allows buying a house now. Housing finance allows you to buy a house now and pay for it over a long time. So it expands, housing finance expands demand. Interest rates and loan terms are, of course, therefore, a major determinant of housing affordability. So the times we're in now, with increasing interest rate, is very stressful on housing demand. And of course, it's very important also on investment decisions if housing finance is becoming less and less available. On the supply side, the same. Developers will only build for a market segment where the households have access to finance or can pay cash, but that's only for the rich. For the middle and low income, developers do not build housing at scale if households do not have access to finance, because the developers have to sell and move to a new project. Developers themselves need access, as we mentioned many times, developer finance. So housing finance, critical, both on the demand and the supply side. But look at the picture. When we see, when we divide the countries in low to very high income countries, we see that in low income and middle income countries, the housing, the mortgage markets are very, very small relative to GDP. So we have to work very, very hard to expand mortgages, expand microfinance for housing, but particularly mortgages for the middle and lower middle income households. So what is the constraint for households to access finance? First of all, low and informal incomes. When you have an informal income, the bank doesn't look at you. What can be done about it? We are going to have a whole session in the course about that. There are very good tools to address that problem. You have to have lienable house and land collateral, so a good registration system of land. We have to have good credit information of the population. And many households have a negative credit history and therefore cannot access finance. And there are very often only one or two loan products in the market that are not suitable for those with informal incomes or for those with low incomes. And we have to adjust that loan product picture. And then there is fear by households of committing for longer term credit or religious beliefs that you shouldn't pay interest or not go in debt in general. So there are many constraints that low income households particularly face in accessing finance. Then there are the constraints faced by the lenders who would like to serve that large, underserved, lower and middle income housing market, but the constraints that they face are serious and they feel that they cannot really move down market. First constraint is the credit risk. So the fear that this borrower, lower income or informally employed borrower, cannot repay the loan. So can I recover that loan? The other one, which is now particularly important, is the risk. We call it interest rate risk, that interest rates during the period, the term of the loan, will change, particularly increase. I make a loan at a certain interest rate at the moment, but my rate increases, may increase over time. How do I deal with that? What are the tools available in the financial system that I can really reduce that interest rate risk? And we talk about that in the course in great length. The transaction cost of making loans for lower income households can be forbidding relative to the size of the loan. We have stamp duty, we have all kinds of costs to originate a loan, and they become a big part of the loan the smaller the loan is. Then we have regulatory cost, the cost of holding extra capital. The central bank may say, if you make loans to informally employed, you have to hold extra capital against that mortgage. So that is another constraint that the the lenders face in order for them to even think about moving to lower and middle income households. So we are talking in the course a lot about those specific risks and costs to lenders and what we can do about it. So wrapping up, what are the priority housing finance policies to expand access? So very quickly, and I know I am already over time, but we started late, so I'm not feeling so guilty. But we must offer on the supply side, on the lender side, diverse and suitable loan products that deal with irregular incomes, loan products that incorporate savings options that alleviate the risk of missed payments, loan products suitable for self-construction, or loan products that address green development. We can have a green mortgage, or loan products, very important at the moment, that deal with inflation. So we cannot continue anymore with the few loan products that are now offered in most markets. We have to diversify and speak to the issues that consumers face in the real market. We have to provide consumer education, and we have done many studies to show that if I educate my consumer on what a mortgage loan is, why it is more advantageous than a consumer loan, why is a mortgage a lot more cheap than a consumer loan, why should you not worry too much to take out a mortgage, because educating them about the rights that they have when they take out a mortgage, or and what a lender can do to them and cannot do to them. So that consumer education has proven to be critical in expanding access to finance. We have to provide client-friendly servicing, and now with financial technology being available, this should be really a non-brainer to reach the population, the underserved population, in a very client-friendly, direct way. We can lower transaction costs, as we already mentioned, taxation and so on. We can offer credit guarantees for loans for informally employed, so that there is, for instance, we establish a public-private credit guarantee system so that lenders are less fearful to make loans to informally employed. And then, again, we can provide subsidies. We can provide a subsidy to the down payment so that the savings requirement is not so steep. So if we do all those things, we have this vision that we move the mortgage market down to a lower income group, and that we move microfinance to a larger scale. So we move microfinance to a larger scale, mortgage markets deeper in the income distribution, so that for all types of households, we have a loan product that make it possible for them to buy or a house or construct a house now and pay for it over a longer period of time. So then on the lender side, we have many ways by the public and private sector to reduce that risk that the lenders face and the cost that lenders face. And we talk about that in the course, of course, better property rights system that is in the public domain has to be done. Improved data systems on house prices, household credit, also a government role the government has to improve the data systems, invest in ex ante before measures to reduce default risk. That can be done. So in the underwriting, what information is available? How do we underwrite that customer that is informally employed? What lessons are there? That is mostly a private sector and with regulatory support, but a private sector initiative. India, we give as an example in the course that has done this very well. And then we support measures to reduce losses when a default does occur. So mortgage insurance and guarantees, that is nearly always a combination of public and private initiatives to institute mortgage insurance. And again, all these things we spent time on during the course, lowering transaction costs, we talked about it, and particularly increasing access to capital markets. When a lender can go to the capital markets to either get a loan against a mortgage portfolio that they develop, that expands the funding component for the lender. Also, when the lender can use capital market funding, it can deal a lot better with the interest rate risk that they run. And that sounds vague for all of you who are not bankers, but we are going to explain in depth what that really means. And all I want to say here that the expansion of capital market funding is critical. And that is to a lot also facilitated by government policy. So all of this will be discussed in the course, and we use lessons from many countries that have already gone through a successful transition. So housing finance for the underserved population is really at the core of the solution to the housing problem. Without housing finance, we really cannot do that. By way of conclusion, we have a major set of economic shocks that we are still going through and that are impairing our options to solve the housing problem, with negative effects to economic growth. But we have to look, certainly as a government, to the fact that the housing sector is an enormous, important component that can drive economic recovery. And therefore, as a government, we have to do everything in our power to stimulate the housing sector. With a targeted approach on priority policy measures, as we discussed many of them, scaling up supply, de-risking developer and mortgage finance, and expanding access to housing finance to underserved households. And this agenda, of course, requires that many policymakers, the ministries of housing, the ministries of finance, the central bank, the local governments, all come together with the private sector to see what can be done. And that is really all I have to say. Apart from the fact that I can only stimulate you to enroll in the course, which will only be half a day over 2 weeks period. So you can continue with part of your checking of emails and everything. So we do it virtually. You can therefore easily participate in the course. And here is the information on how to do that. And now I will stop.
Thank you very much, Marja. And yeah, I'm not sure there's anybody out there who could cover that level of material in the way that you just have and do it in such a systematic way. We have run a little bit over time, but I think completely worth it. If nothing else, this presentation alone is but worth its weight in gold. Folks, it's in the interest of time, I'm going to ask Francois Viruly if he has any points or questions he would like to ask, etc. I have one or two, but I would actually like to give the opportunity to the floor as quickly as possible. A number of people have put some questions into the chat room. So I think let's move across in the interest of time to some of the questions and inputs, and then we'll sum up after that. Francois, do you have any points you would like to make?
Look, I think what really came out, and thank you very much for the presentation, is the complexity of these markets. I also believe that we have a window of opportunity in these markets at the moment. With the commercial market doing poorly as it is, we have many investors turning at the moment to the residential property markets and looking at the opportunities, looking at it more careful. So I think there's also, and I think if one adds to that the Human Habitat SDGs, reporting on ESG, maybe we have a slightly different world opening, at least I hope so, that leads to that. And I think what you also mentioned is the issue of green finance, sustainability finance coming through the IMF and other institutions. So there's maybe more funding available, but I don't know your commentary on that. And then if I were to ask one other question, I mean, if we look at the complexities of this market, I would like to ask you, is there one or two things that are the critical leverage? You know, by the time we've gone to the supply, demand, we can either say that these are such complex markets needing so many interventions, and we could draw a long list of them. But is there maybe one or two that make the big difference?
Yeah, thanks for that question. I agree with you, Francois. More money is becoming available for housing through the international agencies particularly. Not so much the private investors, but the development finance institutions. The appetite for housing is definitely expanding. And it is therefore a very good moment for governments to get ready for them. So why I showed the complexity of a housing market analysis is that the more a government is getting ready for investors, private and international development investors, to absorb money in the housing sector, the better it is. So because the development entities cannot change the regulations, they cannot all of a sudden force bankers to open up, mortgage markets. So the better the individual countries are prepared for the greater availability of housing finance or housing funding, the better it is. And this is indeed a very timely time for individual countries to get ready. And that is why I systematically and it can be overwhelming in 1 hour, I realize that, but to show systematically, and once you break it down in bite-sized pieces, it is not so overwhelming to understand where the problems are and what policies we require to open up these markets so we can absorb as a country more of the money, domestic money as well as international money that comes available for the mortgage market and for the housing market in general. There is a lot of investment, equity investment in developers, in individual lending entities, and so on. So the reason for talking about this and for the course is for countries to get ready.
Right. No, absolutely. So it's creating that conduit. There is funding on the one hand, there's demand, and how do we build that conduit that gets us from the pot to, if I can put it so crudely, to where it needs to be.
So, and on your second question, are there one or two? I have two in my international career. There are two major issues, particularly in Sub-Saharan Africa. The one is opening up the housing finance system, de-risk it, not through subsidies, because you don't have the money, frankly. So really look at the housing finance system and put the risk mitigation tools in place so that you can induce lenders to come into this market. That requires information. So the de-risking requires information. That's the first one. The second high priority in my books is the regulatory environment at the local level, so that we have a local government that really develops or allows standard of housing that people can actually afford, and that can make land available. In many local governments, we have land. We have a lot of land. Local government can make that land available. Or if it is land that is somehow related to the Ministry of Education or the military, local government can insist to grab that land and tell the central government, we need this land in well-located areas for housing. So the regulations and access to land and infrastructure, service land, are critical. Without that, these markets don't work. So those are my two core areas.
Thank you. Thank you very much.
If I can just add on that, Francois, and then I'd like to open it up to this. I think I agree. It is important to recognize the complexity, but not to be overcome by it. And I think the key there is to understand the different parts of the system or the different elements that make up the system. And you can literally draw it. And once you've drawn it, you can then break it up into its component parts, and then you can address the issues in each part. And when you take it apart like that, it becomes a lot more manageable and understand, you can understand where the issues are and how the interventions can take place. To answer your question about the two things, actually very similar to what Marja said, for me, it's ensuring that your housing markets are working properly, because it's very difficult for your housing finance markets to work unless your housing markets are working properly. And the second one is a proper understanding and systemic understanding of the risk amongst the different role players in that system. Folks, can
very much. And if I just want to say, I mean, it just shows again, understand the system, and understand what part of the system, where the holds up are, where it clogs up, and in understanding the system in its entirety.
Correct. And that's very much what the housing finance course actually does. One, we build this system so everybody can see the different elements and components of the system. And then we look at understanding what are the issues in each part of that system, and how you would do the assessment.
Sure.
Folks, I know we are running out of time, but I would like to give the opportunity to one or two people. There have been some questions in the chat group. Would you like to put up your hands? I see there was a question around securitization. And that's a commonly misunderstood phenomenon in the space. It actually has a very important role to play in certain circumstances, but it does need to be done properly. And so there are lessons to be learned. But like most of these things, they do have an important role to play in the different systems. Any other questions or points or points of clarity that people may have?
Rob, can I just add, just when we look at securitization, I don't want to speak for Marja, but we, I think, look at both the debt and the equity. So from the REIT perspective, we have a look at REITs as well in the course, and we look at it from the equity perspective as well.
Yeah, we certainly, on the mortgage side, we look very much at an expansion, not just securitization, but an expansion of access to funding in general. And that may be through liquidity facilities. It may be on the debt side through mortgage bonds, actually. So where the lender keeps the mortgages on the book, but he gets a loan against the cash flow that these mortgages generates. It doesn't have to be the sale of the mortgage into the secondary market. So we look at what is most appropriate and feasible in the different countries. And it depends on the development of your capital markets, the type of domestic investors that you have. So we certainly look at that, but nearly all countries have to begin to look at additional funding apart from the deposit funding that you have in the banking system. And that is because the mortgages are long-term. And if you really begin to expand your mortgage sector, the scale of the mortgage component is too large to handle from the deposit base only. So you really, nearly in all countries, do you have to look at capital market funding for additional funding, but also to de-risk, to take care of your interest rate risk that the banks per se cannot handle. So if I sell my mortgage, certainly now in this inflation period, if I sell my mortgage off my book, I sell the interest rate risk. Now that goes a little bit beyond, we haven't taught you yet how this all works, but that is what it does. And so in this period, accessing capital market to de-risk your, or to get a better handle on your asset liability mismatch, on your interest rate risk is very critical. And we are talking about that in great detail.
Great. There's just a couple of points that were made in the chat room. I mean, but Andrew, your point about governments failing to appreciate the lower risk of housing markets, I think you're right. And I think that's why we've been emphasizing the need to understand this risk, understand where that risk lies, but also the extent of that risk. And I think it probably comes back to an issue that's close to both Marja and to Kesia about getting adequate data and evidence with respect to this risk. And I think that's one of the reasons why there is a lack of understanding of the nature and extent of that risk. There was another question as well, so I'm just scrolling through that. To what extent does the political interference affect the demand and supply of housing? For a lot of us can speak to that. The fact that the state is involved at both a national, often at an interstate or provincial and local level, I think it does have a big impact, especially for me on the bit supply side of housing markets, in what I call the land production, which is basically bringing land to a point that you can start to build something on it, and involving, the provision of land and the registration of land, provision of infrastructure, and very importantly, the provision of rights, development rights, are often quite fraught in the political process. I see there's a couple more questions coming on. See if there's anything else. Folks, we're going to close out quite soon. Are there any other points or questions that people may have?
I can't see, as long as I keep my screen up here, I can't see the chat box. So if there is a question I need to answer, please, you tell me.
I will do. I've been going through some of them, Marja. I'm just hoping that I haven't missed out on anybody. There was a question with respect to the role of savings and the lack of savings and the impact of lack of savings in these BIT markets. I don't know if you have any views on that, Marja.
Well, that's a big constraint. And you need nearly always, in order to get a mortgage loan, certainly as a more risky customer, you need a sizable down payment in the order of 10 to 20%. Mm-hmm. And that can be a major hurdle. So subsidy systems, therefore, often focus on on assistance with the down payment. But there are savings programs or savings mortgages that can be applied as well. The problem with a savings mortgage, and I go into depth during the course, is that if you allow people to save up for a down payment, there is implicitly an understanding that you then qualify for the loan. So you have to be very careful not to overextend your promises to the people that begin a savings program. So you have to then really pre-qualify these people for a loan of a particular house that is built in the future. So you allow people to save up for a year and hope that their financial situation remains stable during that year. So you can actually give those people the loan and therefore allow them to buy the house. So there are difficulties often coming in when you have a savings program for housing.
Thank you. Folks, if there are no more questions, I'm going to wrap things up. Marja, just to sum up, I mean, I think in terms of your presentation and some of the key sort of findings there is obviously housing from the fact that, or from the point of the influence of government on housing is obviously influence across all the tiers of government. Yeah. Housing market constraints have to be addressed in parallel to developing your housing finance markets. There are generally different interventions that are needed for different segments of that market. And to then understand what interventions are needed and what problems they're trying to solve, you need to actually undertake a systematic analysis of your housing and housing finance markets and understand how those are made up and what they consist of and who the key role players are and what are the key risks associated with each one of those BIT role players. As a result, folks, that is very much what the course is structured around. Just to remind you, the course runs from the 2nd to the 14th of October. Marja said it is online, or as Marja said, it is online. We run it in the afternoons, really from 2 to 5 in the afternoons, with a little bit of preparation time from 1 to 2 in the afternoons. And it is run from Monday to Friday over those 2 weeks. There is an introductory course to finance and some of the key finance concepts on the Sunday. So if you do not come from a finance background or industry, we do give you, or we do equip you with the basic understanding of finance, some of the key financial concepts that you will need during the course. If you have any questions, etc., please will you email Heidi Tate? Her email address is up on the screen at the moment, and the course can be, or the course registration and the information associated with that can be found at the website, which is http://www.cpd.uct.ac.za. Folks, thank you very much for your attendance and your inputs. And just a final thanks on my side to Marja, the Center for Affordable Housing Finance and the AUHF, and to my colleague Francois Viruly. And we really hope to see you in the beginning of October, where, believe me, we're going to drill down into a lot of these issues in a lot more detail. So hope to see everybody then in a few weeks' time.